Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial world, and today we're diving into Madison Square Garden sports. Latest report, this is the kind of document that can either be a snooze fest or reveal some seriously juicy details about how a sports giant is really doing. Get ready, because we're about to unpack it all for you. Oh, and before we dive in, if you appreciate getting straight insights from these hefty corporate filings without all the jargon, make sure you are subscribed. We also have a fantastic community building up in our Discord channel linked in the description below. Come join the conversation. Alright, let's get right into it. Madison Square Garden Sports Corp is known for owning some of the biggest names in sports like the New York Knicks and the New York Rangers. This report is a quarterly look at their financial health, and it covers the period ending the 31st of December 2025. Think of it as a check up on how these sports teams and their associated businesses are performing. We'll start by looking at the company's financial snapshot. This is their balance sheet, which shows what they own and what they owe at a specific point in time. On the 31st of December 2025, their total assets were about $1.5 billion. That is a big number, showing significant holdings in property, equipment, and valuable intangible assets like team rights. But here is a critical number to watch on the balance sheet. While the total assets are healthy, look at their equity section. It shows a negative total equity of over $282 million. What does that mean? It means their liabilities, what they owe, are greater than their assets. This can happen for various reasons, but it is something to keep a close eye on. It suggests that if the company had to settle all its debts right now, there wouldn't be enough assets to cover it. Now let's talk about liabilities. Their current liabilities, which are debts due within a year, are a pretty hefty $641 million. A big chunk of that is deferred revenue, which is money received for services or goods not yet delivered. This isn't necessarily a bad thing, as it implies future income, but a large amount here can also indicate significant future obligations. Moving on to how the company actually made money and spent it. This is the statement of operations, which shows their performance over a period. For the 3 months ending the 31st of December 2025, they brought in over $403 million in revenue. That is a solid 13% increase compared to the same period last year. Let's break down where that revenue came from. A big driver was ticket sales for Knicks and Rangers games, up significantly. They also got a boost from league distributions, likely from new media rights deals for the NBA. Suite revenues and sponsorship also saw increases. However, there is a notable drop of over $21 million in revenues from local media rights fees. This is linked to changes in their agreements with MSG networks, where the annual fees were reduced. This is a crucial point because media rights are a huge income stream for sports companies. On the expense side, direct operating expenses climbed by 13%, reaching over $311 million for the quarter. Much of this increase is tied to team personnel compensation, likely reflecting higher player salaries and the impact of league revenue sharing and luxury tax expenses. Selling general and administrative expenses went up a more modest 2% to about $69 million. This includes things like marketing, executive salaries, and other corporate costs. The combination of higher revenues and higher expenses led to an operating income of over $22 million for the quarter. That is a significant jump of 67% from the previous year, showing the company did a better job of turning its increased revenue into profit despite higher costs. But when we look at the 6-month period, the picture changes. They actually reported an operating loss of over $5 million. This highlights how seasonal sports businesses can be, with a stronger performance in one quarter not always translating to the entire half year. The direct operating expenses really ate into the gains from revenue, even with the media rights revenue decrease becoming more pronounced over the longer term. Now, for something interesting, the miscellaneous income or expense. For the 6-month period, they reported a net income of over $13 million here. This is largely due to changes in the fair value of their investments. Remember those Extract 1 warrants and equity investments. Their value fluctuated, and in this period, it swung in their favor. Let's shift to cash flow. This tells us where the actual cash is coming from and going. For the 6 months ending the 31st of December 2025, they used over $52 million in cash from operations. This is a big change from the previous year when they generated over $35 million. The main reason for this cash drain from operations is a significant increase in changes to working capital. Imagine it like this: they invested more cash into things like accounts receivable and other assets, while not collecting as much cash from sales or from paying down liabilities. A big part of this was a lower increase in deferred revenue. While deferred revenue is good for future earnings, A smaller increase here means less cash came in upfront compared to the previous year. Investing activities also used cash, though less dramatically, around $2.7 million. This was for things like capital expenditures and buying investments. Financing activities used about $16.6 million, largely due to payments for financing costs related to recent credit facility amendments. Speaking of credit facilities, let's look at their debt. They've recently amended and extended their credit agreements for both the Knicks and the Rangers. The Knicks revolving credit facility is now up to $425 million, and the Rangers facility is up to $250 million. These are big credit lines, providing substantial borrowing power. As of the 31st of December 2025, they had borrowed $267 million under the Knicks facility. The interest rate was around 5.08%. For the Rangers, there were no borrowings outstanding as of that date, but they have a credit line available. Importantly, they also have an advance from the NHL for the Rangers, which is a debt that has to be repaid. Now, a quick look at ownership. The Dolan family and associated trusts hold a significant portion of the voting power, around 70.8%. This means they have a strong influence over the company's direction. These notes are where the financial details get really granular. We've already touched on revenue recognition and their media rights agreements, where reduced fees from MSG networks are impacting income. In their investments, Extract One common stock is listed at a value of over $18 million. And those Extract One warrants, which can be seen as a form of derivative, are valued at almost $7.5 million. These investments can be volatile, and their changing values directly impact the company's miscellaneous income or expense. The company holds around $103 million in indefinite, lived intangible assets, primarily listed as sports franchises. This represents the valuable, long-term rights and brand associated with teams like the Knicks and Rangers. They also have goodwill, which is an intangible asset arising from acquisitions, valued at over $226 million. Both of these assets were tested for impairment and found to be okay, meaning their value is considered sound. This section is what management says about their own performance. They mention that their success depends on the popularity and competitiveness of their teams, which makes perfect sense. High player salaries and the impact of league salary caps and luxury taxes are key factors. They also acknowledge the impact of general economic conditions, especially in the New York area, which can affect ticket sales and sponsorships. They also present adjusted operating income, which is a non-GAAP measure. For the quarter, this was about $29.6 million, a good increase from last year. This adjusted number typically excludes things like depreciation and share-based compensation, aiming to give a clearer view of core operational performance. So looking at the bottom line again, they reported a net income of over $8 million for the 3 months ending the 31st of December 2025. This is a huge turnaround compared to a net loss of $6.4 million for the same period last year. This is driven by higher revenues, particularly from ticket sales and league distributions, even with the hit from lower media rights fees. Now, what are the potential storm clouds? The report outlines many risks. Labor disputes like NBA or NHL work stoppages could severely impact their business, changes in league rules, economic downturns, especially in New York, and the performance of their affiliated companies are also major concerns. The ongoing success of their teams, the Knicks and the Rangers, is obviously paramount. If they don't perform well, fan engagement and revenue can suffer dramatically. Alright, let's look at this broader picture. Madison Square Garden Sports Corp is navigating a complex landscape. On one hand, their core fan, facing businesses like ticket sales and sponsorships, are showing strength, leading to a solid quarter. The increase in league distributions points to favorable new media rights deals in the broader sports landscape, which is a positive sign. However, the negative total equity on their balance sheet is a long-term concern that suggests a high level of debt relative to assets. The decrease in media rights revenue due to the agreement amendments with MSG Networks is a significant headwind in a key revenue area. The company relies heavily on the performance and popularity of its sports teams. When they win, revenue climbs, and when they don't, it hurts. They are also exposed to economic conditions, especially in the competitive New York market. Their significant debt load, while offset by substantial credit facilities, needs careful management. The strength of their adjusted operating income is a good sign for core operations. But the impact of fluctuating investment values on their miscellaneous income highlights the volatility in their non-core earnings. The fact that they had an operating loss for the 6-month period despite revenue growth shows that cost management, especially in direct operating expenses like player compensation, remains a critical challenge. What is my takeaway? Madison Square Garden Sports Corp is a business directly tied to the unpredictable world of professional sports. They have valuable assets in their teams and venues, but they also carry significant debt and are subject to the whims of league economics and team performance. While the recent quarter shows improved profitability, the negative equity and the 6-month operating loss suggest ongoing challenges. Investors should watch closely how they manage their debt, how the new media rights deals play out, and, of course, how the Knicks and Rangers perform on the court and ice. That is our breakdown of Madison Square Garden Sports Corp's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think the negative equity is a red flag, or is it all part of the sports business model? Drop your thoughts in the comments below. If this analysis was valuable to you, hitting that like button really helps us out. And make sure you subscribe for more deep dives into the corporate world. And don't forget to check out the Discord community link in the description to connect with other financial enthusiasts. Thanks for watching, and we'll see you next time on Corporate Decoder.